such an asshole!
Hey everybody, assholeconsultant.com, banging them out here. If you got a question and you have money and you don't want to fuck up your life, I'm just going to go and any degree is a good degree. I'll just sign off on these college student loans and not worry about it. Yes, stop right there. Don't make stupid mistakes like that. Contact me at Asshole Consulting. And we won't make your life today better, but we promise to make your life or your future life a lot better than what it would be had you not consulted the great aura of the asshole. Hey Cappy, I know that you can't give investment recommendations on advice, but I'm more interested in the general idea of taking out a loan to start investing. In case you want more info, the particular ETF, that means exchange traded fund, it's kind of like a mutual fund, that I'm interested in is a large cap sector diversified, but based on specific companies and the S&P 500. It is a low quality and low risk with a 0.69 beta, which again for the commoners, that means it's at 0.69. 70% is volatile. So if the average stock in the S&P 500 goes up by 5%, this would only go up by 70%, so 3% roughly. In other words, it's not as volatile. It's only 70% as volatile in the price swings as the S&P 500. The distribution yield, I think you mean dividend yield, is 3.8%. And the stock price has been on the rise since inception in October of 2012 thanks to all the quantitative easing. I just added that last part. I've never taken out a loan before, so this is new territory for me. But if all variables are constant, then I can pay back the loan through dividends in 27 months' time. I have a steady job that pays well, so I can always pay back the loan through my own pocket. If I'm successful in paying back the loan, then I'm going to buy more ETFs to diversify and put my dividends to work for cumulative returns until I have passive fuck you income. It all seems good on paper. What do you think, Cappy? I think it's a horrible idea because I asked you. I said, okay, the dividend yield, you're going to make 3.8%. I said, what's the interest rate? You said 5.25%. So here's a good time to learn a little bit about entrepreneurship and more importantly, the difference between income and capital gains. Any asset, let's use that terminology. It could be a stock, it could be a company, it could be an ice cream truck. Any asset you buy is going to have to generate or has the potential to generate a certain amount of income or profit each month, quarter, year, whatever. Okay? And the way we measure that profit, whatever, is, okay, what percent of the money did you invest in that company is earned back in the form of profits? Now, in the particular case of the stock you're looking at, you are at a dividend yield of 3.8%. That means if you buy $100 worth of this ETF or this fund, you will get $3.80 per year in dividends from that fund. Okay, $3.80 divided by 100, 3.8%. So that's what you're going to receive from this investment or this asset. The problem is, in order for you to buy it, you have to borrow money at 5.25%. So let's say you borrow, keep the math simple, you borrow $100, you have to pay the bank 5.25%. That means each year you pay the bank $5.25 so that you can make $3.80. And now you see why this is a very, very bad idea. Okay? This is this happens out. This plays out on much larger terms with corporations. Corporations borrow billions of dollars. They pay varying interest rates. The interest rates go up and down, but in the end, the company has to generate more in profits than it does in interest expense in order to legitimize borrowing money to finance that investment, if you're following me so far. Okay? So right off the bat, you're losing money. Now, a piece of you may be saying, hey, yes, I may have to pay back the loan. Yes, I may be losing money on dividends with my interest expense. I want to pay that off with money from myself, and then the stock price will go up. And that is the difference between a capital gain and profits, or income, or cash flow, whatever you want to call it. Let's just say profits to keep it simple. The problem in investing in a stock, because you, quote, hope it goes up in value sometime in the future, is that is not controlled by you. That is controlled by the ups and downs and the whims of the stock market and the global economy. All right, let's say it was 1998 and you bought a .com stock, and let's say it didn't even require you finance it by borrowing money at 5.25%. You just took $10,000 of your 401k money and you threw it into a .com. Well, by 1999, that sucker went down to like, I think 25% its original value. The underlying profits of the company could not have changed. They could have stayed the exact same. That asset, that company you bought could have been the exact same company with the exact same profit generating potential. It could have still generated that 3.8% return. The stock market doesn't care. It will go up and down as it feels. Whatever wind will spook it or drive it up into bubbly new heights. Another perfect example, a little more recent in memory, the housing bubble. Everything's going great under George W. Bush, even though people don't like to admit it. Unemployment was low, GDP was high, but people kept borrowing more and more and more money to buy houses, sometimes houses they didn't even live in because they're going to flip because, housing prices never go down. So everyone borrowed money at 3, 4, 5%. They bought houses. Do houses generate income? Not unless you rent it out. And as prices went up higher and higher and higher, what income they could theoretically generate would come nowhere near to paying the interest on the loans and the mortgages you borrowed. And soon, sure enough, people who bought the houses one day say, I don't want to buy no more houses. Price of the housing market collapses, price of houses go down. And now you spend $300,000 on a house that's only worth $150,000 and a mortgage of $275,000 accruing at interest rates of 5 to 6%. Okay? In other words, what you need to do is separate two things. And here's I'm going to simplify it for you. I don't give a shit about capital gains. I really don't. All right? Any real investor looks at what kind of rate of return are they going to get. And the reason very simple is this. I'm giving you my money. What are you giving me in exchange? Or translated into real English, I'm giving you part of my finite life. What are you going to give me in exchange? And if they say, oh, well, I know you are borrowing at 5.25%, but we'll give you 3.8%. That means I'm losing life and time. I'm losing my money. I'm losing my time. I'm losing my life. I made a bad decision. I made a bad investment. Okay? So right when you're telling me what kind of dividend yield the investment is making and what you got to pay to borrow the money to pay for it, you're already losing money on this investment. It's a no-brainer. Don't do it. All right? If you want to then add, well, the stock might go up, yeah, but that's not under your control. What if it goes down? Now, not only are you making less a percent, you're making the same percent and you're still losing money because you got to pay out more in interest. Now, what you borrowed, you say you borrowed $10,000, okay, and you buy $10,000 of this stock, or this ETF, sorry, and it goes down to 5, oh shit. Now you lost $5,000. That's assuming you sold. Well, then you could hold on to it, but then you got to hold on to it for 10 years to make your money back. And each year you're paying out 5.5%, which on $10,000 is what? 10, that's 5, 10,000. Is that $500? Did I do the decimals right? 1,005 is 50. Yeah. $500 a year. And all of a sudden you're losing your money just in interest costs alone. All right, so do what I do. I only look at profits. I only look at dividend yields. I only look at what kind of actual rate of return that asset is generating. This is why I don't invest in a 401k. And to be honest, what I invest my money in, the majority of my investment goes into advertising for my books. That's where I take my presumed 401k and IRA money. Because if I go advertise on Tom Likas, which I recommend you do, if I go advertise on Terrence Popp, if I go advertise on the Beckloff, I go advertise on this like handful, a little bit more than a handful, almost a score of relatively small but increasing in popular bloggers and podcasts. I drop my money there. That doubles my money in terms of additional book sales. So I spend $100 on, let's say, the Beckloff on the month. I can expect reasonably so to get about $250 worth of extra book sales. That's a rate of return of 250% in a month. All right? The sheeple, the fucking American sheeple, jerking off to their 401ks and their IRAs. Oh, it's a dividend yield of 4%. It's a dividend yield of 4%. Oh my God. Oh. Well, I just can't. Why? Oh, you're only getting 0.25% in the bank account. The bond pays 3%. Yeah. Are you guys fucking joking me, or did y'all? Oh, that's right. Y'all forgot what it was to be Americans. That is entrepreneurial. Anyway, that's how I look at investments. I need to make a much higher rate of return. All right. Another example, why I invest in Davis Arena and not the S&P 500. I paid Davis. What did I pay Davis? I ran the numbers. Basically, I paid Davis. I made an investment in myself through my books. I had him record Bachelor Pad Economics. Let's just do the numbers. Let's say it was $1,000. Okay, I gave Davis $1,000 to record Bachelor Pad Economics. Now I collect book sales or royalties from the audiobook of Bachelor Pad Economics, and I think I estimated it to be like an extra $200 to $300 a month. Ended up being, at least for the past year, $400 a month in extra book sales. All right, that's $400 on $1,000 investment per month. That's 40% a month. All right, this shows you why entrepreneurship, if you got a good idea or you think you got a good business investment, to do it yourself. Otherwise, you're going to go and get the ETF. I don't care what it is, high risk, international, diversified, small cap, large cap, micro cap, doesn't matter. Your dividend yields are not going to be as high returning as a good business idea, albeit you may have a small business idea and it can't, I just can't go borrow $10,000 because I don't know that many advertisers that go and double my sales. Anyway, the point is that you got to look at what is your cost to borrow the money, and then what's your rate of return going to be on it. Now, I pay cash because I actually don't have a huge marketing expense, but I pay cash. I basically just take book sales and I reinvest it in marketing to increase book sales even more. All right? So I don't have an interest expense. You are going to borrow at 5.25% to invest in an asset that only generates 3.8%, thereby guaranteeing you will lose 1.45% if I did the math right. And that doesn't even account for inflation. So with purchasing power, you're probably losing more around 2%, 2.5%, maybe even 3%. So anyway, to answer the literal question you had, no, that's a stupid investment. Don't do it. But understand why is a much more important economic lesson, or more an investing lesson, that you and everybody else should learn about rates of return and what makes an investment. An investment is not something that just goes up in value because reasons. All right? If you want to look at a classical example, look at the Holland tulip bulb bubble back in like the 1500s or the 1600s. All right? Look at that. What you want to do is look at the rate of return you're getting on the amount of money you invested. I put down $1,000. What's my rate of return? 6%. That's $60 a year. I put down $10,000. My rate of return is 7%. That's $700 a year. And what I think Americans really ought to do, take a page from Bachelor Pad Economics, is start asking themselves if getting a 2% right now, you look at the average stock in the S&P 500, it only generates a 2% dividend yield. 2%. That's all you get. You give them $100, they give you 2%. You're not even beating inflation on the S&P 500. But the stock goes up. The stock goes up. The stock goes... Yeah, I know. You guys all went to the Carlson School of Management and you're dumber than shit. But hear the old captain out. In the end, you're only making 2% a year on that investment. If you go and come up with a good entrepreneurial idea, or your buddy has a good entrepreneurial idea, or even go into lendingtree.com, do the peer-to-peer lending, you should at least be able to get 6, 7, 8%. You should be able to get much better rates of return than this bullshit that you're going to get in dividends, not capital gains, dividends that's being paid out in the S&P 500. But if you really want to make good rates of return, you want to make your money work for you, sorry guys, it's entrepreneurship. That's how you do it. And you're not going to fucking find it investing in that over-flooded market with all those trillions of dollars of baby boomer money, not to mention the trillions of dollars, I'm not making it up, guys, that Obama just printed off through quantitative easing, and all the governments and well, not the governments, but actually some foreign governments are investing in the stock market with their own quantitative easing money. But with low interest rates, corporations have borrowed trillions of dollars to buy back. That market is flooded. Flooded. Doesn't mean the stock market won't go up. Matter of fact, if we keep printing off money, the stock market will go up. It's called hyperinflation, but it's the stock market, so that's good. That's okay. But if you want a return on your money, entrepreneurship is pretty much the only game left in town. Anyway, if you got more questions, you can always go to assholeconsulting.com and tap my super awesome economic genius for a price. This topic right here, if it interests you, I strongly recommend you get the book Bachelor Pad Economics. It is written for men, but ladies, if you can hold your nose and tolerate the locker room talk, you would benefit from it greatly, because I go and I delve into way more detail than what I do here about investing, entrepreneurship, what is a rate of return, etc. You can listen to my podcast called The Clary Podcast. You can find that on SoundCloud just by searching it, Clarey. And I got a ton of other books that are beyond Bachelor Pad Economics that will help every person, young, old, fat, skinny, kids that climb on rocks. You can go to Amazon, search Aaron Clarey, Aaron Clarey. Toodles.